The Federal Reserve faces its most pivotal year in decades as 2026 unfolds with unprecedented political pressure, a looming leadership transition, and deep internal divisions over monetary policy that could fundamentally reshape American economic governance. With Jerome Powell's term as Fed chair expiring in May 2026 and President Trump preparing to announce his successor, the central bank finds itself at the center of a historic battle between presidential authority and institutional independence. The immediate drama centers on Trump's expected announcement of Powell's replacement, which he has promised to make in early January 2026. The president has narrowed his selection to a shortlist of 5 candidates, with Treasury Secretary Scott Bessent leading the vetting process. According to multiple sources, the race has effectively come down to what Trump calls the two Kevins: National Economic Council Director Kevin Hassett and former Fed Governor Kevin Warsh, with Fed Governors Chris Waller and Michelle Bowman also in consideration, along with BlackRock's Rick Rieder. Trump has made his expectations crystal clear, declaring on Truth Social that anyone who disagrees with cutting rates during good economic times will never be the Fed chairman. This unprecedented public ultimatum represents a direct challenge to the Federal Reserve's traditional independence and has created what many economists describe as a loyalty test that could fundamentally alter how monetary policy is conducted in the United States. Kevin Hassett emerges as the perceived frontrunner, with prediction markets giving him a 58% chance of securing the nomination. As current director of the National Economic Council, Hassett has been a vocal critic of the Fed's current leadership and argues there is ample room for interest rate cuts due to strong productivity gains. His close proximity to Trump and alignment with the president's low-rate agenda make him the loyalist choice, according to insiders. However, his nomination would likely face intense scrutiny from senators concerned about Fed independence. Kevin Warsh, serving as the establishment alternative, brings significant Wall Street credibility from his tenure as a Fed governor from 2006 to 2011, including his experience managing the 2008 financial crisis alongside Ben Bernanke. Prediction markets give him a 25% chance of nomination. While Warsh has criticized the Fed's drift into politically charged areas like climate change, he is generally viewed as more traditional and potentially more resistant to political pressure, though his relationship with Trump could override such concerns. The timing of this leadership transition could not be more challenging for the Federal Reserve. The central bank is grappling with what economists describe as a two-front war, fighting stubbornly high inflation that remains above the Fed's 2% target, while simultaneously addressing a softening labor market that suggests the economy may be cooling faster than anticipated. This dual challenge has created deep divisions within the Federal Open Market Committee, leading to multiple dissents at recent rate votes. Current economic data presents a mixed picture that complicates monetary policy decisions. The economy grew at a robust 4.3% annualized rate in the third quarter of 2025, marking its strongest growth in 2 years. However, unemployment has been rising, and job growth remains insufficient to prevent further increases in unemployment, particularly when excluding healthcare sector jobs. This dichotomy between strong overall economic growth and labor market weakness has created an unprecedented policy challenge. The Federal Reserve's recent actions reflect this internal tension. After cutting rates 3 times in 2025, bringing the federal funds rate to a range of 3.5% to 3.75%, the central bank faces pressure from different directions. Some officials favor additional cuts to support the labor market, while others prefer holding rates steady to ensure inflation doesn't reignite. The upcoming January 27th to 28th FOMC meeting is expected to result in a pause, with markets pricing in only modest easing throughout 2026. Adding complexity to the Fed's challenges is a dramatic reshuffling of voting members on the rate-setting committee. Starting in January 2026, the Cleveland, Philadelphia, Dallas, and Minneapolis Fed presidents will gain FOMC votes, replacing those from Boston, Chicago, Kansas City, and St. Louis. This rotation will bring new hawks to the committee, including Cleveland Fed President Beth Hammack, who has already stated her preference to hold rates steady until spring. The loss of Chicago's Austin Goolsbee and Kansas City's Jeffrey Schmid, who voted against recent rate cuts, will be offset by equally hawkish replacements. The political pressures facing the Fed have reached levels not seen since the 1970s. Trump's repeated public criticism of Powell, calling him a stubborn ox and too late on rate cuts, represents an unprecedented breach of traditional presidential restraint regarding Fed independence. The president has also criticized the central bank's costly renovation project in Washington, D.C., which has run significantly over budget, adding another layer of political vulnerability. Legal challenges add another dimension to the Fed's current difficulties. The Supreme Court is scheduled to hear a case on January 21st regarding Trump's authority to remove Fed Governor Lisa Cook, whom the president fired over alleged mortgage fraud charges that remain unproven. This case could establish crucial precedent for presidential power over Fed governance. Additionally, Powell must decide whether to remain on the Board of Governors after his term as chair expires, potentially serving until January 2028 and maintaining some influence over monetary policy. The broader economic context makes the Fed's job particularly challenging. Artificial intelligence investment is driving significant technological transformation, creating productivity gains that some argue justify lower interest rates. However, inflation remains stubbornly above target, and the recent government shutdown has disrupted official data releases, leaving the FOMC flying blind on crucial economic indicators needed for policy decisions. International implications of Fed policy changes are significant, particularly for Gulf central banks that maintain currency pegs to the dollar. Any dramatic shift in U.S. monetary policy direction could force corresponding changes in other countries' interest rate policies, potentially creating global financial instability if markets perceive the Fed as compromised by political influence. The mortgage market provides a real-world illustration of how Fed policy changes affect consumers. Current 30-year mortgage rates average 5.99%, down from peaks above 7% earlier in the cycle, while 15-year rates average 5.38%. The Fed's rate-cutting campaign in late 2025 has created a more favorable borrowing environment, though rates remain elevated compared to the ultra-low levels that prevailed for much of the 2010s. Wall Street's expectations for 2026 reflect the uncertainty surrounding Fed leadership and policy direction. Markets currently expect only 2 quarter-point rate cuts during the year, bringing the federal funds rate to 3% to 3.25%. However, some economists, including Moody's Analytics' Mark Zandi, predict the Fed could surprise with 3 cuts in the first half of 2026 due to labor market weakness and political pressure. The Fed's balance sheet policy adds another layer of complexity to 2026 planning. At its December 2025 meeting, the Fed approved purchases of Treasury bills and coupon bonds at a pace of up to $40 billion per month for reserve management purposes through April 2026. This operation is designed to maintain ample reserves rather than provide economic stimulus, but the timing coincides with the leadership transition in a way that could create market confusion about policy intentions. The independence question extends beyond the chair position to the broader structure of Fed governance. Trump's successful appointment of 3 current governors, Waller, Bowman, and Moran, gives him significant influence over the Board of Governors even before naming a new chair. Stephen Moran's term expires January 31, 2026, giving Trump another appointment opportunity to further reshape the institution. Academic and policy experts are watching the situation with growing concern about precedent and institutional integrity. The traditional pattern of Fed chairs serving across party lines, with recent chairs like Volcker, Greenspan, Bernanke, and Powell serving under presidents from both parties, has helped maintain public confidence in the institution's independence. Trump's explicitly political approach to Fed leadership selection breaks with this bipartisan tradition. The nomination process itself will be closely scrutinized by the Senate, which must confirm any new Fed chair. While Republicans control the chamber, some senators have expressed concerns about maintaining Fed independence. The confirmation hearings will likely focus heavily on the nominees' views regarding presidential influence over monetary policy and their commitment to data-driven decision-making. Looking ahead to the remainder of 2026, several key milestones will shape the Fed's trajectory. The January FOMC meeting will test whether Powell can maintain consensus during his final months as chair. Trump's nomination announcement, expected in January, will trigger intense market analysis of the candidate's likely policy approach. The confirmation process could extend into spring, potentially creating a period of policy uncertainty during the leadership transition. The long-term implications of 2026's Fed developments extend far beyond monetary policy. The outcome will establish precedents for presidential authority over independent agencies, influence global perceptions of American institutional stability, and potentially affect the dollar's role as the world's reserve currency. If markets lose confidence in Fed independence, it could lead to higher inflation expectations and force the central bank to maintain higher interest rates than would otherwise be necessary. The current situation represents a fundamental test of American democratic institutions and the balance between elected authority and technocratic expertise. The Federal Reserve's ability to maintain credibility and effectiveness while navigating unprecedented political pressure will determine not just monetary policy outcomes, but the broader health of American economic governance for years to come. As this historic transition unfolds, financial markets, policymakers, and citizens worldwide will be watching to see whether the United States can preserve the institutional independence that has been crucial to its economic stability and global financial leadership. The decisions made in the coming months will reverberate through the American economy and global financial system for decades to come.